Most people are familiar with the stock dividends that are paid out on a quarterly basis. But did you know, there are other investment funds that pay monthly income that are usually higher than what is paid out by individual dividend stocks. Dividends have always been the gold standard of investing. If you took the total stock market returns of the S&P 500 since 1957, the overall return turns out to be just about under 8% annually. But if you actually reinvest the dividends throughout those years, your total return increases to over 10% per year. Adding inflation into the mix shows how important it is to have your investments outpace inflation, especially around the time of making this video, where inflation has increased to 7.5%. Most people who get into dividend investing would usually invest in the classic list of stocks called dividend aristocrats, or the dividend kings. These stocks have paid out dividends for the last 25 years or 50 years respectively. These are stocks that are well-known, stable, and most likely continue to pay and increase their dividends over time. However, dividend yield on these stocks are usually at 3% annual rate or less. Most stocks that fall in the technology category would pay out about 1% or less annually. A good portion of the growth of these investments do come from the stock price appreciation. So the common strategy is to reinvest those dividends back into the portfolio, until such time that you want to live off the growth of your investments and dividends. That sounds peachy and all, but here at Broke-Ass Capital, we like to invest outside of the box. There are investment funds whose sole purpose is to pay out regular income that outpaces the yield you get from the typical dividend stocks portfolio. Some of these funds focus on specific category of dividend stocks, while others focus on option premium approach. In any case, it's up to you to do your own research into whether or not these funds are appropriate for your own stock portfolio and financial goals. Oh yeah, this is not financial advice, yada yada yada. For those that prefer the straightforward high dividend yield investing, Vanguard High Dividend Yield ETF could be your thing. VYM focuses on investing in selection of stocks that pay high dividends. The fund has about 400 stocks that are spread out in various industries. This is for those who just like to keep it simple. The fund expense ratio is 0.06% and the annual dividend yield is about 2.8%. Not bad. Other similar funds would be the ProShare S&P 500 Dividend Aristocrats ETF, or the Schwab US Dividend Equity ETF. They are more or less invest in stocks that have long and proven history of paying dividends. The next list of funds utilize the option strategy to earn monthly income on the portfolio. Some of these funds use option on a portion of the portfolio, or what I call the hybrid approach. Global X S&P 500 Covered Call and Growth or the NASDAQ Covered Call and Growth ETFs are such funds. They essentially buy the stocks in the respective index, then sell covered calls on 50% of the portfolio to earn modest monthly premiums that are paid out to shareholders. Typical hybrid funds would give out about 6 to 7% annual yield, but they do have higher expense ratios though. These funds charges 0.6%. Similar fund would be JP Morgan Equity Premium Income ETF. Instead of doing a straightforward option play, they utilize what's called equity-linked notes. These are essentially financial contracts created on the underlying stocks that would pay out based on the performance of these stocks. If you're thinking this sounds like mumbo-jumbo financial jargon, well, it is. Leave it to JP Morgan to make things complicated, right? But essentially the equity-linked notes with the investment on the stocks provide a returns made up of price appreciation and regular monthly income. The current yield on JEPI is about 7% annual rate, and their expense ratio is 0.35%. The other type of option funds use a specific strategy called the net credit collar option. Essentially these funds buy the respective index, usually the NASDAQ or the S&P 500, then sell covered calls against it, and at the same time, using some of the covered calls profits to buy out of the money puts for downside protection. The difference between this strategy versus all the other funds I have mentioned before is that it provides a downside protection in severe market crashes. Those puts usually pay out if markets crashes beyond 5% in a given month. Funds like Nationwide Risk Managed Income ETF, or the Global X S&P 500 Risk Managed Income ETF are examples of that. These funds typically pay out about 7 to 9% annual rate. Their expense ratios are higher too, typically around 0.6% or more. These funds usually tend to be somewhat flat in terms of the price appreciation, so the growth would come from reinvesting those premiums. As I have mentioned before, the best way to manage these types of monthly income funds is to reinvest those dividends or premiums back into your portfolio. Nowadays, most brokers allow for partial shares ownership, so there wouldn't be any issue if you can't buy whole shares with your dividends or premiums. The main thing is to utilize the power of compounded interest, where the bigger the portfolio, the larger your future income will be. Some people like to mix and match these funds to get a more balanced total return. Remember, typically the higher the dividend or premium payout, the lesser the overall price appreciation. So it's important that you consider where you are in your financial journey as you research these funds. Some people just prefer higher income, while others rather take the purely growth approach and sit on it for decades for better return. Anyway, that's the end of this video. I hope the list I have shared of these types of funds that pay out monthly income would give you some ideas on what would be appropriate for your own investment portfolio. If you find this video helpful, please leave a like and subscribe to the channel. Thanks for watching.